Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our program, my guest and I will discuss everything under the sun in regards to real estate, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. Joining me on our show today is Louis Camarasano. Louis owns the website schmogl.com, which is SMAULGLD.com. He's a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert and has been mentioned in numerous publications: Wall Street Journal, CNN Money, Fox Business, Forbes, AOL, MarketWatch, etc. So he definitely knows his stuff. Louis, how you doing today?
Doing grand, Ryan, and you?
Can't complain. How was your 4th of July?
It was very hot, but it was good. You?
You know, it was hot here too, but it was a pleasant surprise because it's been raining almost every day for like the last 2 weeks, it seems like. So I'll take the sun over the rain any day.
Yeah, it's an excuse not to cut the lawn, right?
Exactly, yeah. We just kind of hung out by the pool and, you know, relaxed and enjoyed the fireworks last night. So it was a good day overall.
Oh, good.
So now we're back, everybody. The markets are back today. I know that we have the unemployment number that's going to be due out at about 8:30 this morning, I believe.
8:30.
Yep, 8:30. So that's going to be something that, you know, hopefully in the middle of the show we'll be able to keep our eye on it and discuss it. But it looks like the current estimates are for the unemployment rate to have declined to 7.5% from 7.6%. Non-farm jobs, a positive 161,000. Non-farm private jobs, plus 179K. And as usual, the data is not likely to match the estimates. The question for the investors and traders is going to be, which way will the deviation take? What's your guess as to where you think the jobs number is going to hit today based upon everything that we've heard from the Fed over the last week or so? Do you think it's going to come in better than expected?
It's hard to say, Ryan. I don't like to guess on those numbers because they are estimates. They get revised. And what I'm looking at right now, Ryan, is the ECB and the Bank of England and the Bank of Japan have all indicated that they are on an indefinite easing policy, and we still have this Fed talk of taper in the cards. And then the question is, if the employment number is good, is that going to put everyone in a panic that the Fed is serious about tapering? Because if this employment number is good, then they're justified in saying, hey, we did our job, we can ease. Europe, Japan, England are different kettles of fish. They need to keep easing. We don't. And that would create a tremendous imbalance in the economies because the dollar is already very strong and is strengthening against the other currencies. It would continue to strengthen if the markets believe that the Fed was serious about tightening and use the jobs numbers to kind of back up that concept. But then that'll throw the United States in imbalance as well, because you saw last week, or I think it was earlier this week, the export number is way down for the United States. And, of course, if the dollar is stronger, it's going to be even more hard for the United States to close that gap on exports because the dollar will be too strong for foreigners to buy U.S. goods. So it's going to be very important to see what the number is. If you want me to venture a guess, I'm going to say I don't think the Fed wants there to be a very, very good employment number. I don't think they want their bluff called on tapering. So I'm going to guess that the employment number instead of 161 won't be a huge miss, but it'll be a miss, maybe 165,000. And then the markets will breathe a sigh of relief that the economy isn't that bad because the jobs slightly improved, but not so much that the Fed's going to taper. What are your thoughts?
Yeah, I agree with you 100% there. I mean, I feel like, the Fed is setting all these expectations of hey, we're going to start to pull back our QE3 or our purchases of mortgage-backed securities if we get to that 7% unemployment number, which you and I have talked at length that that's not even the real number. So I'm happy that they feel like 7% is the goal number and that they could really stop buying mortgage-backed securities, which would automatically send mortgage interest rates higher. And you and I discuss this stuff week after week. So for those of you that, think that we're talking about employment and what the Fed's doing, these things are critical aspects of the real estate market. People don't tend to look at these things, but they're the key indicators of where potentially the Fed might make a move that would shift interest rates up like it has almost 0.75% in the last couple of weeks. The employment data today, I think, just like you said, is probably going to come in right at the number, if not just a touch worse. I think that it would be probably a very bad thing for it to come in much better than expected, because that would really have the stock market rally further. They're already very bullish. As we can see, the stock market, is, I think, way overbought at this point. But if you want to add more fuel to the fire, then if this employment data came in much better than expected, that would fuel that fire. Mortgage interest rates would get much worse today if that takes place. And I don't think
it's funny how good news would be horrific news if that were to happen.
Yeah, and this is, obviously the people on Wall Street love to have this news if they're playing in the stock market. But for those of you out there that are looking to, to buy a home or to refinance your home, trying to take advantage of the interest rates, as low as they are while they're here, that's not the news that we want to hear. We don't necessarily want to hear that employment got much better, because we will see a substantial rise in interest rates. I can promise you that, especially with the volatility that we've had over the last couple of weeks. Obviously, we lost almost 0.75% in about a week and a half period. We gained some of it back last week, which is good news. There's always a point in time where, bonds get overbought or oversold. And so when we had that huge tank in the market and mortgage interest rates got, extremely bad over a course of a week and a half, it was only a matter of time before they pulled back a little bit. But just you can remember that everything can be reignited with good employment numbers or overall just good numbers in the economy. So it is important, and for those of you out there shopping for a mortgage right now, that you are working with a professional that's paying attention to this stuff. If I were you, I would make sure that I'm asking the questions of, hey, well, do you know what economic activities are on deck this week that can affect interest rates? If your potential loan officer or loan professional that you're working with can't answer those questions, you might want to consider running away. I mean, look, I can't tell you how many times that I've heard people where they think that they're locked in, they're floating. They're floating because the loan officer might have said, hey, I'm going to give you 4%, but we'll leave you floating until closer to the time of closing. Hopefully we can get you a better interest rate. Well, if you didn't lock in at the 4%, and now all of a sudden we get positive economic news today because the employment data is great, well, then what happens to that 4%? It just disappears. Then they go back to the borrower and say, oh, well, sorry, the 4%'s not there. I was hoping to get you a lower rate. Now it's 4.25%. The smarter play is to probably advise or ask your mortgage lender professional if they offer a free float down option, which means that they would be able to potentially lock you in at the 4%. And then if between the time that you're locked and you actually close, let's just say it's the standard 30 to 45 days, rates get much better. Many of the big lenders will allow one free float down option. So you're protected with the lock feature there, but you can still float down to a lower rate. I think many people don't even know that that's an option that's available to them, Lewis, because they don't even know that to ask for it. You know what I mean? There's a lot of banks that might use that as a marketing feature that they offer that, but not too many. Believe it or not, many people will say, you have to have got to be locked into the contract, sign the application, all that. Well, you have to sign the application and all that, but you want to also have the benefit if between today and 30 days from now rates get better, that you can lower your rate down.
That's good advice.
Yeah, and without having to jump ship and go to another lender. Many people try to play the, I'm going to use this good faith estimate and I'm going to go take it over to this guy. I'm going to have him beat that and then bring it back to this guy and have them beat that. Well, I understand why people shop, I think that it's still really important. Most interest rates and most banks are going to be probably within an eighth or 0.25% of each other, but it is important that you're working with a professional that's going to give you the advice and the guidance that you need to time the market as best as you can and protect you from potential negative economic data in the markets that could send interest rates going skyward instantly.
You mean positive economic data that would send interest rates? it's really obscene that good economic data is really seen as the catalyst for higher interest rates. But actually, that's true. If there is an improving economy, then interest rates would naturally rise. But here, what we're talking about is if there's good economic news, it means that the Fed is going to stop QE and therefore not be artificially manipulating interest rates lower. Just a quick point, Ryan, on the non-farm payroll. They will include all the really not menial jobs, but the part-time jobs in that number. And so even if the headline number is over the 161, it really won't mean that the employment picture is improving. It'll just mean that more people are getting part-time work and accepting part-time work. And that's really why I'm looking at a number that's slightly higher. But that doesn't mean that the number of full-time work is improving. It just means that they're adding more part-time work. And then also, I would guess that the average work week would stay at the 34.5 hours a week. Now, you did see, Ryan, that the Obama administration put off the requirements for small business owners to start Obamacare early next year, and they pushed it out to 2015. And I think that's a ploy to not slow down hiring going into the year, because that's what many employers are saying. They don't want to add employees if they're going to be hit with the bill, and they're hoping that they'll get through the 2014 elections, and then in 2015 that'll come along. What are your thoughts on whether that will impact employers' willingness to hire in the next 6 months?
I think it could help temporarily, but once again, I as I spoke last week, just as small food chains like Carrabba's were hiring multiple part-time employees to try, because they were basically setting up for next year what was going to take place. If this was going to have to be implemented in 2014, they were just going to hire pretty much double the part-time workers versus just having half the full-time workers, right? So I think that it could help because it's going to give some sort of clarity for the next year, but I still think that a lot of these companies are going to say, well, you know what, that's great. We still need to start preparing for it now.
Right.
You know what I mean? I don't think that these companies are going to say, oh, great, we were given another year, so let's go hire some full-time workers now. I don't think that's going to be the case at all.
Yeah, I didn't see the part-time signs around my neighborhood come down. I see in that Lowe's, Target, grocery stores, all offering jobs, none of them full-time, but saying that we have evening shifts and day shifts available.
Yeah, and I mean, I think that's going to be more the norm. And as you suggested, when we see those non-farm numbers that include the part-time workers, yeah, these jobs numbers should shoot up there, because if we have double the part-time workers in the force now, but not near as many of full-time workers, I mean, that's not a healthy economy. These people aren't working full-time. So, and that's
the question, Ryan. Can you have a part-time economy? I don't really think you can unless the productivity is there. The reason these jobs are part-time, it's because they need people there for a certain amount of time, not because they can do a full-time job part-time. It's because they need people to be in the store and to unpack the inventory and put it on the shelf, not because somehow you now can do an 8-hour job in 5 hours. It's just because they need people to run the shifts, and they're not willing to hire people full-time to do it.
Right, and how efficient is a part-time economy, right? I mean, when you're...
Well, it would be if it was technology and people are getting the work done in 2 hours and being super productive and then sitting by the pool, but that's not what we have.
Right. I mean, as you said, you have Lowe's and Home Depot hiring evening and night shifts. So I don't really think that productivity is changing. We just have more part-time workers, and that's really all it is.
And your income is lower, and it's harder to get a mortgage, but if home prices are rising, you have a part-time job, you get priced out of the market. And that's why the housing recovery isn't sustainable. You've got college kids coming out without work, or underemployed, or part-time workers. These people cannot afford to buy a home, either because they're not working enough and getting paid enough, or because they have large amounts of debt, and the price of the homes is too high. Just because interest rates are low doesn't mean that either they can get the loan or they can qualify for a loan for a home of the size that they would need.
Absolutely. And, one of the questions that I got on the website, realestate360live.com, I believe it was a week or two ago, was, coming from a person that had a part-time job, they've actually had a couple of part-time jobs for the last 3 or 4 years, and they were asking while applying for a mortgage if you could actually count those part-time jobs. So I did want to let them know that you can count the part-time jobs as long as you can show a history of 2 years of that job. Now, remember that it's not, you're not getting, a salary, or basically you don't have 40 hours a week. So what they're probably going to do is they're going to take an average of your hours for the last 2 years from that job. Now, if you've only been on the job, like let's say you have one part-time job for 2 years and another one for only 1, they can't count the one that's only for 1, only the one with 2. So a lot of the time, those people that are working part-time jobs have multiple part-time jobs, right?
Right.
So because they're trying to make a full-time pay, but they have to do it from multiple jobs. So it gets very sticky, though. You still have to have that 2-year history with each job in order for them to be able to count part-time income. So if you're in that situation currently and you're trying to figure out how you can get a mortgage but kind of stuck, this is what you're going to have to wait for. You're going to have to kind of let time take its course. And if you're trying to buy and you're always job hopping from one job to the next to get the higher pay, that's going to hurt you because you're going to go to the new job making more money, but you don't have the 2-year history of that job. So you got to be very careful as to what you're doing, especially if you're trying to buy a home, even if you think, hey, I have the same line of work with this part-time job as the other one. It doesn't always work that way. If it was a full-time job and you leave from one place and go to another in the same line of work, then it's okay. But it's not the same thing when you're dealing with part-time jobs, and it's just because underwriters are going to look at part-time work completely different than they would a full-time job.
And Ryan, can you also cover for our listeners how they view self-employed people? If they're in a similar situation, that the more they make, the more adverse their tax position is. But if you try to reduce your taxes, then what happens?
Yeah, so obviously everybody has a top-line number on their tax returns that when you ask a person what did they make and they say, I made $100,000 last year, and they're a self-employed borrower, they have their own business, they've been running their business for the last 2 years, so that's pretty much one of the requirements right off the bat is you have to be self-employed for at least 2 years. And then there's a few circumstances where it can be less than that, but there's a lot of other factors that have to come into play, and very few people will hit those. But you'll have a top-line number of $100,000, but then all of a sudden, as a business owner, you have all these expenses, and you're writing off everything. So at the end of the day, you get all the way to the bottom line number on that tax return, and their adjusted gross income, which is pretty much what the underwriter is going to be looking for, says that you only make $30,000. So, yes, it's great that you made $100,000, and you did make $100,000. However, after all expenses and everything were paid out, because you are the business owner, you only made $30,000. Well, the underwriter is going to take that $30,000, okay, and that's the number they're going to give you credit for. And let's say that that was 2012, you made $30,000, and then at the end of 2013, let's say your adjusted gross number was $50,000. Okay, so you made 30 and 50. What they're going to do is they're going to take a 2-year average. So 30 and 50, they're going to give you credit for $40,000 over a 2-year period. That's the income that they're going to qualify you off of. So you have to be cognizant of the fact that, you're a business owner and you feel like you're making enough money to make these mortgage payments, but it's a completely different animal when the underwriters are reviewing your tax returns or your loan officer prior to the underwriter and saying, well, hey, you're not going to qualify for a $400,000 house. You're only going to qualify for a $200,000 house. Now, when you're dealing with your CPA, you just really need to come up with a tax structure to make sure that maybe you might need to pay yourself a W-2, right? You might need to come up with a different plan so that when the underwriter does review your stuff, that it looks like you can afford those $400,000 payments. Now, that was a circumstance where the income was increasing over 2 years. Let me tell you what happens if it decreases. In 2012, it went from 50, and then in 2013, it goes to,
I'd say when Ryan gets back, he's not going to have good news with what happens when you have a decrease in reported income as a self-employed person in the second year.
All right, sorry about that, guys. I had a little sneezing attack.
I was saying you probably have some bad news for us if your income goes down in the second year.
Yeah, I absolutely do. I have bad news for you, because what's going to happen is they're going to actually take the lower. They're not even going to average. So if it was 50 and then 30 in 2013, they're going to take the 30,000. They're not even going to average them out to give you the 40. So the underwriter wants to see that you've basically been not only maintaining, but if you want that higher income, it has to be increasing each year. Well, for small business, that can be very difficult, especially in an economy that's not moving upward.
And Ryan, especially in an economy where, let's say, you are doing well and you want to reinvest in your business, well, those reinvestment expenses are deductible and they will come down from your net income. So in both instances where you have a part-time worker who could leave their job and a part-time job and get a better part-time job, which would be to their benefit, it's going to be to their detriment in looking for a home. And similarly, a self-employed person who would make sense for their business and for their long-term economic fortune to make investments, which would be treated as expenses, they're also going to hurt their ability to buy a home. So it's kind of a catch-22 for people who want to improve their economic circumstances and also want to buy a home. The two, in these two instances, are not compatible.
Absolutely. And
you got to make a choice. Do you want a home or do you want to make more money? And the reason you want to make more money is because you want to buy a home.
Yeah, and, the IRS, the government, everybody, they all know, hey, if you're going to qualify for a loan these days, they're going to make sure that you have to document that on your tax returns, which essentially means if you're going to buy a house and you're self-employed, you're going to pay more taxes because you need to show that higher income.
Right.
You know what I mean? So you can't. There's really not a way to get around it at that point.
So basically what you can do, I guess, as a self-employed person is you don't take your legitimate business expenses just to show the higher income for purposes of getting your mortgage.
Absolutely. Yep. And it's pretty sad because a lot of people that are in good positions right now, like let's say they've got their 20% saved up, they've got that money in the bank, and then only to find out that the whole time they're thinking in their heads that we should have no problem qualifying for a $300,000 or $400,000 mortgage, whatever it may be, and then the underwriter gets a hold of their tax returns and basically says, well, hey, I understand you're putting on your 20% and that you have 800 credit scores, but unfortunately, the income that you're showing on your tax returns is not going to be the amount that we need. So they're back to the drawing board, which if they're going to buy, then that means they have to buy less of a home than they wanted now, so they'll be renting for another year. But sometimes it could be as much as 2 years because even if you bring up your income so substantially the next year, they're still going to average it out from the prior year. So it could put somebody literally from buying the house that they want, which is probably double what they can maybe afford right now, or not afford, but on paper afford. It could take them 2 years to get to that point. And why that's frustrating, Lois, is because we know that interest rates, obviously, they've been rising and very quickly lately. So people are kind of like, that have been on the fence for the last few months and saying, hey, I'm just going to hope that interest rates keep going down further. Once they get down to like 2.5%, then I'm going to buy. Right. Well, now that they've made that shift up, everybody's saying to themselves, well, I guess if we're going to do it, we need to do it now. Well, if you weren't planning, meaning that you haven't already gone and talked to a mortgage professional, you haven't talked to a real estate agent in your market to find out what the home prices are, what stuff's selling for, because I'm shocked at the amount of people that I talk to every day in Northern Virginia that say, hey, well, I've heard, that you're able to buy a single-family house in this neighborhood for $400,000. And then I'm like, well, that was about 8 months ago. Now it's $450,000. So you need to really prepare for the future, and especially since there's many people in the situations that we talked about, part-time workers, self-employed workers, you need to be creating a plan in order to get yourself into that house. And it's not just as simple as showing up to the lender one day and thinking that he's going to hand you a loan, because it's not that easy anymore. You're planning basically 2 years in advance to make sure that you've got the income to support that mortgage. So my hope is that interest rates for those people that want to take advantage of them will stay relatively low over the next 2 years, if that's the situation that you're in currently.
But hope isn't a strategy, though. I mean, it's probably not going to be the case. It's
not. And so with that being the case, you should not only be preparing for 2 years from now, but you should be preparing if interest rates are 4%, 5%, or 6% or higher, and what your strategy would be in all of those instances. I mean, Louis, I can probably count on my hand how many people would actually take the time to plan out that type of stuff, right? There's a few, but the majority is just everybody wants stuff like right this second, right this minute.
Oh, absolutely.
And that's the type of economy that we're in.
It's a credit-driven economy, except the one stumbling block. You can do that with a car. You can walk into a dealer nowadays and get that 3.5%, 4% loan. They'll just give it to you. But that's not the case with homes. With basic any other consumer item, people have been conditioned that you can buy on credit.
Yeah, I mean, everything. And mortgage is just much tougher, the much tougher type of credit to get right now. And really, the only people that are getting lent big money are the huge, huge companies out there. Banks will lend to them, but the smaller guy, you really don't have a chance in the world. I've had a few conversations lately with a couple government contractors in the area that since nothing's gotten passed with the budgets at this point, that a lot of the jobs that they had or the current contracts that they have, the government just basically came in and put them on hold. So they're paying them for work that was already performed, but not any future work. They're just basically in a stalemate at this point. Well, these companies, one of the ones that I was talking about had a couple hundred employees that now don't have that work to perform. Well, they're still on that company's payroll, and now they're slashing employees left and right. They're trying to get some sort of bridge loan or line of credit from the bank. And do you know that the banks aren't willing to help these people? They don't want to lend a dime to them. And they're basically their answer to them when they come to them is look, hey, we understand that most of you government contractors are all in the same boat, but unfortunately right now we're not lending any money to you. That's not a good situation to be in, Louis, because that's going to run a lot of the small business government contractors right on out of the business. And people that were very dependent upon the government, it's not in a good position for you to be in right now. Many people all the time, it's a great business to be in when you have these government guaranteed contracts. Well, I always tell people, you got to remember that at any point in time, those government guaranteed contracts can just disappear. And that's what's taking place. Once again, something else that's not good for the overall economy. But if you ask the Fed or if you ask Congress or you ask the president, are things going great? He'll reflect back to these same numbers that we're talking about, Louis, the unemployment rates, right? That doesn't necessarily mean, though, that the economy is turning around like they want everybody to believe that it is.
No, it seems like there's almost a concerted effort to create this mirage. You hear the words recovery bandied about constantly, but you really don't see it in the overall economy. Even in the official statistics that they give you, a GDP number well under 2%, unemployment still very high, the labor participation rate at 32-year lows. I don't see what recovery they're talking about other than the need and wish for one. But really, they point to consumer sentiment. You and I have talked about that. I mean, consumer sentiment, you're dealing with consumers who basically they don't understand the underlying data. They just know whether they're getting a paycheck or whether they're able to buy a house for cheaply. But consumer sentiment is never a good indicator of economic activity. It's usually at the highest just before everything falls off the table. And of course, we mentioned the stock market is up, and so is real estate recently. So those are the three indicators that people are saying, wow, the economy is better and is in recovery. But we know why real estate is up. It's because of big money moving in, taking advantage of historically low interest rates. We know why the stock market is up, because companies can use cheap loans to buy back their shares. There's they've cut costs, so their earnings look better, and so really the economy, the underlying economy isn't better, but they're saying there's a recovery because based on those items. And I think it's almost 8:30. Did we get the number yet, Ryan, for the did it come in? June payrolls 195. The expectation was 165. So that tells us that, I mean, things are going to collapse right now because that means tapering is, at least in people's minds, now on the cards.
Yep.
195,000. I mean, that's going to be a big hit probably to mortgage interest rates. They should shoot up. Gold and silver should go down. Unless there's something under those numbers. I only have the headline number. But that's a pretty big beat of the number.
Yeah, I mean, that's definitely going to give Wall Street all it needs to let that stock market ride higher, which means more people will be pulling out of bonds and interest rates. Yeah, they're going to get higher today for sure. Once again, I mean, this is a weekly occurrence here, though, that it's, you might have some good news and bad news, but remember that interest rates, the way mortgage interest rates work is that they are very quick to rise and very slow to come down. I mean, it takes a long time for them to come down. And the trend that we've been riding over the last 2-3 weeks has been nothing but up. And we get an occasional pullback here and there. But,
and Ryan, the May payrolls were previously 178. They've been revised upwards to 207. Interestingly enough, though, the unemployment rate remained at 7.6%. Now, what we need to do is look through these 195,000 jobs where they are.
Exactly.
Now, underemployment rate, the U6 climbed to 14.3%. Previously 13.8%. So that's exactly what we're talking about. The number came in well ahead of expectation, but the reason it came in, it appears initially, just from the headlines I'm looking at, is because more part-time workers came into the economy. So really, should the Fed taper because QE has done a tremendous job of creating part-time workers? They may decide to pull back and say, what we've been saying all along is that the unemployment rate isn't really the right way to look at it. Because I think that the Fed wants any excuse to continue QE, but they also want to be able to be kind of the cleanest towel in the dirty laundry bin against the Bank of England, Bank of Japan, and European central banks. So they want to at least be talking tapering as opposed to the others are just saying that they're going to continue to print till they hit their inflation targets. So there's data in here that if the Fed wanted not to taper, to say that while we're getting a strong non-farm payroll, unemployment rate is still stubbornly high, and basically underemployment is still high, and it's increasing. The underemployment rate, the U6 number, went from 13.8 to 14.3. So this really isn't the big beat that you expect. I mean, that you would normally cheer. It is higher than the 165 that was expected, but it's made up, it looks like, from
part-time workers.
Part-time workers, yep.
And it'll be interesting to see how people talk about this. I mean, when they break it down. I mean, I know that the Fed doesn't always like to dive into that. They like to use those, just the firm unemployment number. Like you said, to me, they should be talking about the U6 number all day long, but they don't want to talk about that number. That, to me, is the more important number. Like you said, okay, that's great. We have part-time jobs going up, but yet the regular unemployment number didn't change, and the U6 number got worse. To me, that should be negative news, right? But they're going to the way the market's going to interpret this, though, is it's positive news.
Well, that's the initial reaction. Let's see. I mean, the knee-jerk reaction of the algorithms and the day traders was to shoot down gold and silver on the concept that there's not going to be a tapering. I mean, that there's going to be some tapering and that QE is going to stop. But perhaps when they dig behind the numbers, people may realize that this isn't the good news that the Fed was hoping for that will allow them to taper. I mean, it's a big number, but not when the unemployment rate stays at 7.6, and when underemployment increases by a pretty dramatic number.
Yeah. We'll keep our pulse on this, and then next week we'll dive back in and see how how the market kind of digests this, and obviously this is a former Friday, so we'll see where things head into the next week on Monday. It's interesting. We talk about all this, and I was reading a couple articles. They were asking a lot of CEOs of different companies like Zillow and Fannie Mae about mortgage interest rates. And, this is like the million-dollar question. Where are mortgage rates headed in the near future? And obviously most of the people believe that the rapid rise in rates that we've experienced over the last month that are not going to be sustained, and that they're going to level off probably somewhere in between the 4 and 5% range. But Zillow director Aaron Lance suggested that it's impossible to predict. However, we expect there to be a lot of volatility, probably between 4.5% and 5%. Bankrate.com's mortgage rate trend index last week, 20% of the experts said rates would go up this week, 30% said rates would go down, and 50% said they would remain unchanged. And Doug Duncan, the chief economist for Fannie Mae, recently addressed where mortgage rates may eventually end up. His comments were, I don't think the Fed ultimately would be troubled with a 6.5% mortgage rate. Now, I don't know what he's talking about, but if we get a 6.5% mortgage rate, Louis, you and I both know that the real estate market will probably come to a halt.
Oh, even before then.
Yeah, I mean, I still think
because that takes the speculative froth out of it totally from the big money investors, and it prices out the mom and pop home buyer.
Yeah, I mean, now is 6.5% on a mortgage still a good rate? Yeah, sure it is. I mean, I feel like anything that's in that 6.5 or lower is a great rate. I don't think that I hope that we don't get to 6.5 anytime soon. Just basically because I don't think our economy is strong enough to handle it. But
unless the economy improves to the point
right.
where it can handle 6, but you're talking about rates getting to that to just because the Fed stops buying bonds.
Right. Yeah, and then Freddie Mac's vice president and chief economist confirmed that as the economy continues to improve, we expect to see continued upward movement in the long-term interest rate. Well, that's, like you said, this is like a mirage of everything's getting better, and so let's just let interest rates rise so everybody can continue to feel like everything's getting better. That's what the mantra that they're out there preaching is that, oh, look, everything is getting better, economy's getting better, employment's getting better. So interest rates
it's almost rise. Ryan. It's almost like I did a blog post on this, like that point in Woodstock where all the people are out in the field and it was raining, and the guy gets up on stage and he says, if we think real hard, we can stop this rain, and everybody yells, no rain, no rain, and the rain continues to pour down on them. I mean, you cannot wish a recovery by headlines and just saying. I'm looking on a Twitter feed right now, and you can just see the cheerleaders saying solid recovery, 195,000 jobs created. And, of course, you see the reverse in that, people saying, but underemployment is up 14.3. And right. For most people, they say, well, I don't know what a U6 is, so forget that. The 195,000 jobs are created. And then you see underemployment, and they say, but they still have jobs, so recovery. And it seems like that's what you're seeing is the concept that somehow we can create an environment where people are going to convince themselves or trick themselves that it isn't rainy economic bad news.
Yeah. Yeah, you're right. And I mean, it's definitely interesting to kind of watch. It's like you said, there's always two sides of the coin, and everybody's going to interpret the news differently. You and I try to take it for what's face value and look at things for how they really are, but people on Wall Street, they're going to do anything to get a position that's going to help them convince their clients of one thing or the other, right? So,
well, it's also a political thing. I mean, you have people who have vested interest, and you and I don't. I mean, in fact, you would have a vested interest for low interest rates forever, even though you're totally against how the Fed is engineering those low interest rates.
Right.
I mean, You should be the biggest proponent of QE on the planet since you're in the mortgage business. You should say, yeah, they should just keep interest rates low forever, and they should just continue to do whatever it takes to keep interest rates low. But you see it, and as I follow on the Twitter feed, the people that are diehard Keynesians or administration fans, they will constantly point to positive recovery. And then you see the people that are against the administration, all they want to talk about is how bad the economy is. But no one's really looking at how, taking a realistic or objective view of what the economy is. And certainly the Fed isn't. I mean, the Fed is about as biased as it can be because what it wants to do, it's appointed by government. It wants to feed government. And if the Fed wasn't buying all these U.S. Treasuries and mortgage-backed securities, the federal government couldn't borrow all that money. So obviously they want to say what they're doing is working. So it seems that there's a huge political, and that's probably the worst thing to do, is to put into the hands of politicians and the politically motivated the health of the economy through some type of central planning, because markets work and go to where the money would naturally go, and they allocate capital the best. But once you put it in the hands of somebody who says, well, we want it to go here because we have a political motive, that's when you have these imbalances that we have in the economy, and that's when you get bubbles.
Yeah. I mean, and it's like you said, I could be running around, touting, the interest rates, it's so great that the Fed's doing this. But, I mean, obviously I see long term that these things aren't good. But I do advise my clients, though, if you're able to take advantage of the situation, then it's fantastic, right? You got to be practical about things and say, since they are where they are, let's ride it out as long as we possibly can. For investors that I work with that are trying to buy up real estate, I'm helping them, find properties where they have positive cash flow. But I'm not in the same breath telling them, hey, let's necessarily buy a ton hoping for appreciation over the next year or two, because there's a lot of things that could throw a monkey wrench in that. And speaking with all my clients, I try to take a more practical approach and explain to them why what's going on is going on. Because I think that, the more educated the consumer can be about this, they can start to look through the numbers like you and I do every week and say, that's great that they're telling us this, but I don't believe it. And you're able to make better decisions, I think, when you can, look at the employment number and determine that, okay, that's great that everybody thinks that the economy is turning around because the non-farm payrolls are up. But U6 is up also, so that's a negative thing. I mean, you need to be able to understand that. Now, maybe not on a very deep level, but when you're watching Fox 5 and they just throw out, employment's getting better, you can actually take the time to say, I can look at a couple other numbers, and that doesn't make sense to me. But the average person out there, Louis, is the only information they're getting is just like the headline numbers, right? Most people only read the headline and don't read deeper into the report.
And there's a second component to that analysis that you have to make is not just what you make of the numbers, but what are the typical knee-jerk reactions that the market will make. I mean, that mortgage interest rates will surge today. And what will the Fed do? And generally the Fed is more difficult to figure out in the short term because what they don't really do anything in the short term, it's what they say in the short term. But if you look at what the Fed might do, I mean, you and I called this last year that the Fed was going to keep QE going all the way into this year, and they have. Now they've only just started talking about tapering, but they haven't done it yet. And so the moves are made not just on what the Fed does, but on what's the reaction going to be. And right now, it looks like the markets are saying, the Fed is definitely going to do some tapering in September, and that's bad. They don't know what they're going to do in September, if they're going to taper, if by how much, but the expectation is that's what's going to happen. And so they're going to price that in prospectively. They're going to say, we're going to take the markets down to the level as if the Fed taper is going to taper in September. And then really the question is, tapering, what are the numbers going to say between now and September? Will they change that concept? If anything, if people start to believe that these employment numbers aren't that good, and let's say next month we get another really good number, and it's the same type of number, 195,000, 200,000, but the U6 continues to go higher, then people will start to discount the possibility of taper and discount that higher non-farm payroll number and start to realize, it'll sink into people, wait a minute, we have a part-time economy. Can we taper if we have a part-time economy? Part-time workers, lower wages. Now, I did see also in the data that our average hourly pay went up a dime. So you're getting some wage inflation, but that could be also because if you're working part-time, it's a lot easier to increase a part-time worker's pay because you don't have all the benefits as it is to increase a full-time worker's pay.
Yeah, absolutely. I mean, you can afford to do that.
The bottom line, Ryan, is the economy is not, from the numbers we've seen, is not improving. And you and I would say, well, that doesn't mean they should do QE because you and I don't believe they should do it in the first place. However, if they're going to look at it objectively on the basis of they think QE can help the economy, well, it still needs a lot more help, which leads me to believe they'll continue with the QE, especially in light of the fact that just yesterday, the ECB, the European Central Bank, and the Bank of England just basically said, we're continuing with our low interest rate policy. And the Bank of Japan says they're too far away from their inflation target, and they're going to continue to print money. So there's no way the United States Federal Reserve is going to go in the other direction and allow all the other countries to debase their currency and to have the dollar so strong.
Right.
It's just not going to happen because that would kill the recovery too.
Oh, absolutely. And I mean, I'm looking at the mortgage-backed security trading table right now, and the Fannie Mae 30-year 3.5% coupon is down about 100 basis points right now. So that's probably going to equate to about another quarter in interest rate. I mean, that quickly we just lost. And that's specifically what we started talking about at the beginning of the show, Lewis, is just this little bit of news today. Just to potentially, now obviously things are going to probably go back and forth for the rest of the day as people are interpreting the report and as more and more people, they start having the economists on their shows and they start breaking down these numbers. But as of right now, it's 100 basis points, which is, like I said, it's probably going to equate on lenders' rate sheets about 0.25% in interest rate. So now we have to have negative news, negative market news in order to get the interest rate to come back down, which we haven't been getting that much of the negative news lately.
Well, the negative news is there. It's just not the headline. I mean, I look at this number, Ryan, 13.8 to 14.3 rise in the U6 measure of underemployment. That's the bad news right there.
Right. Yeah. But yet the market's take on it, obviously based upon what I just told you, is that everything is fine and everything's moving in the right direction and that they're going to anticipate that the Fed is going to taper in September. And that'll rise. That'll push interest rates even higher. Absolutely. Yeah. I mean, if the Fed starts to taper, for those of you interested, the minute that they start to taper, we will see a huge increase. I mean, it'll probably be almost an automatic 1% increase in interest rates, just automatically. Oh, if they do it in September, we'd be at 6% 30-year. Absolutely. It's not higher. It's not higher right. Because the small amount of other private participation in the mortgage-backed security market would completely pull out, right? I mean, there wouldn't be really any – there would probably be some private capital that would enter back in once they got to that 6 to 6.5% level because it's been a good investment for them again. Mortgage rates – But who could afford it at that point? Right. Well, the only thing that could happen, though, is if then home prices dropped. That's how you can keep the demand, and they would drop if you had interest rates going to 6%. Yeah, and then we still have part-time economy with more part-time workers here that are trying to afford mortgages at 6%, 6.5%, whatever it could be. I don't think that that's going to bode very well for the real estate market that's been trending upward, at least in most of the metropolitan areas lately. And the other thing people aren't factoring in, Ryan, it's been lost. I mean, it's kind of been this sideshow about taper, sequester, all that kind of stuff. The underlying U.S. debt situation, which you and I talked ad nauseum 2 years ago and last year, no one talks about that anymore, that somehow that isn't a threat to the underlying economy. And it'll come back as a threat because the amount of borrowing, the cumulative borrowing, and the current deficit is still very high, and the only reason we're able to even think of sustaining those debt levels is because interest rates are low and because the Fed is buying U.S. Treasuries. If the Fed stops buying and interest rates go higher, then that kind of forgotten elephant in the room becomes very apparent because that'll become front line and center again, the U.S. debt crisis.
that the U.S. owes enormous amounts of money, and the interest on the debt is now going to get even higher and therefore make it even more unsustainable to carry these high debt loads.
And that's the one reason, Lewis, why I feel like it's not going to happen in the near future. I don't think that they're going to even start to taper because of exactly what you just said there. I mean, about the, of what it would cost to maintain the debt level. I mean, could it maybe go up another percent or so and still be doable? Yeah, but once we get closer to that 6% range, it's going to be major trouble. And like you said, I think how much of the focus has been shifted away from the debt levels and the debt ratings in this country, right?
I haven't heard about that. I don't think in any of the general conversation and the general headlines, nothing. It's been forgotten that the U.S. is on a unsustainable trajectory in debt growth. In fact, they try to throw good news on it that the deficit may be a little lower. Well, it's already over $1 trillion, so if they can knock it down, it's still a ridiculous amount.
Yeah, I mean,
that's just the current level.
It's kind of funny because we were talking about that a lot. Remember, about a year and a half ago, and all the ratings companies were basically getting ready to downgrade us all over the place. And now, economy's strong, everything's turning the corner. You know what I mean? And now basically we've been upgraded. We've been upgraded all over the place. So, this is just another. It looks like just another bubble, like I said, that's been created by the Fed. But it's not just that, like you said, for the real estate markets. It's for just be able to service the debt levels that we have. It's all tied in together, really, Lewis. I mean, and the Fed's just the mastermind behind it all.
As I've been saying, it is no exit. I really think that they cannot. They might be able to ease a little, and I think they might want to test what the shock is. And they may taper from $85 billion worth of mortgage-backed and U.S. Treasuries, maybe down to 65. But as I've also pointed out on the Small Gold blog, that's still larger than QE1 and QE2 on an annualized basis, unless they keep tapering it back. I think if they taper it to as you mentioned, down to maybe $65 billion, this is in monthly purchases, which is an enormous amount of money. The markets will react, even not just on the anticipation of it, but they will react when they actually do it, because there is a component in the market that thinks they're bluffing. It's a minority view, but a lot of people think that's just not going to happen, and you and I are in that camp. Yep. But if they do it, then people like us will start to take them more seriously, and that'll drive interest rates even higher. And at that point, that's when what Krugman says is they may have to reverse course, but at that point they've lost credibility, and at that point they may have lost control over trying to keep interest rates lower.
And you would think that...
Because it would appear desperate if they were to go back and then say, okay, we're going back to $85 billion.
Absolutely. And you would think that the Fed's probably thought that scenario through. You know what I mean? Because I think that's the last place they want to be in is in the desperate mode. So I don't even see them tapering at all. Right? I don't at all. I think it's just all put out there to make it seem like, the economy's turning the corner. But realistically, I don't see them tapering at all. If they do start to taper, I could see middle of next year, end of next year. I don't see anything this year at all. I think that the closer we get to that, they're going to really start bringing up maybe some of the things that we've been discussing, which is looking at the U6 number. That's not really getting better. Much more of part-time workers. And then now that Obama's pushed back his target for small business to implement Obamacare and all that, I don't know. I mean, that's more of a political thing than anything else. But
Ryan, maybe there is a wild card, and that wild card could be Egypt.
Yeah.
Egypt could provide extreme volatility in the region. It could provide a surge in oil prices. It could provide some type of need, so to speak, for military intervention. I mean, what happened over there, we didn't talk about it today, was quite remarkable. I mean, you had the Arab Spring a year or two ago, and it was heavily touted in the media as a form of self-determination of the Arab people that they haven't seen, and they all voted in Islamic fundamentalists, but it was cheered on because they were democratically elected. And now what's happened is the people of Egypt, and I don't know whether it's majority, minority, but somehow they convinced the military that Morsi, the head of Egypt, who was democratically elected, was not in the best interest of the country, whether he was democratically elected or not. And their argument was that now that he's been democratically elected, we will never be able to get rid of him because he's now behaving like a dictator. Well, that goes against, the United States was very much in favor of democratically elected governments, irrespective of who they elect.
Right.
Now, the noises out of the administration are, this was not a good thing to do, that these people acted non-democratically, almost in mob rule fashion, and deposed this guy. So that cuts against the entire strategy that the U.S. had, was to, like, the United States allowed to let Arab countries elect their own leaders. I mean, that's kind of an ironic situation. We're going to support that. We'll let them elect their leaders. But now that they've decided they don't want their elected leaders and they've thrown them out, the United States is in a bind because they're supposed to support democracy in all its forms. And clearly, when you toss out an existing president, that's not democratic means. You're supposed to go to the ballot box and vote the guy out next time. So that could create a very volatile situation depending on what happens next. Now, there should be a counter response to the regime that was deposed. They're not going to just go lightly and say, well, that's fine. You know, you decided to use the military and kick us out. They're going to probably respond, and perhaps violently. Yeah. And if that situation kind of sparks up along with Syria, you could have reasons to continue QE because the economy will be hurt, because at a minimum, you may have disruption in oil supplies.
Right. Well, and it's always, you know, there's always something that throws a monkey wrench in the plans, right? So that could be the one thing that takes place, and we'll have to keep our eye on that.
Wasn't it odd, though, Ryan, I want to get your thoughts on this, that somehow there was this massive groundswell amongst the Egyptian people that they were able to muster up the ability and to wrest control of the military from the existing president to pull this off.
Yeah. I mean, it definitely shocked me. I mean, I didn't think that.
It's unprecedented, like that really. I mean, generally, it happened, and it happened quickly, and it happened without a lot of gunfights, and I don't think we've heard the end of this one.
No, probably just the beginning. And I mean, I'm sure this is definitely we should keep our eye on, like you said, because it could have some definite implications here. We're coming up on the end, Louis, but I wanted to throw out this week's credit tip of the week, like we do every week. Obviously, many people out there, when trying to obtain a mortgage to buy a home, they get their credit report and they see that they might have a collection, like a parking ticket, in you know, especially for those of you driving downtown in D.C., 2-hour parking, and then you come back and your car's been marked with chalk and you've got your ticket. Now it shows up on your credit report because you didn't pay it. Or you were driving through basically a red light and they had cameras on the stoplights and you get your ticket. It takes a picture of your license plate and you get a ticket in the mail, you know, months later. Or you forgot to pay it now at this point. Now it's showing up on your credit report. Now you have that ticket that's now been sold to a collection company. And now not only is it being reported from one company, it's being reported from another, and you've got collection companies calling you all over the place and basically harassing you. I mean, collection companies are not fun to deal with because they'll call up you and everybody they think that you're related to, friends, family members, just trying to get money back from you. Well, the Credit Pro's tip is that if your clients or you are being harassed by a collection agency, that the one thing you should make sure you do is send them a written letter stating that they should never call you again and that the only contact made should be by snail mail. And you want to send this letter certified return receipt and keep the proof. Why it's important, I mean, obviously, Louis, it could be very annoying if somebody's calling you 40, 50 times a day, right, trying to get a hold of you.
Absolutely, yeah.
I mean, it's just absurd. I mean, how annoying they can be. If you do this, if you send that, and then the next call, whether it's you get the call, your neighbor, your boss, or anyone else regarding your debt, it's basically a clear violation of the law, and it's basically an open and shut case, a lawsuit that you can put against them. Now, I'm not saying for everybody to go do this to set up a lawsuit, but I'm just saying it to keep the clowns from calling you every single day or calling, people at your job or your relatives. I mean, the last thing people want is to feel like they've been violated. And I mean, when people are calling you, harassing you for bills, in many instances, Louis, they're bills that aren't even theirs. Medical collections sometimes end up on people's reports, and it's for somebody with the same name. So I see this happen all the time, and I think that this is just a quick little tip for people that are being bothered by collection agencies, that they can just send in a letter to say that they never want them to call them again. It's a quick little easy fix that you can use, and if they bother you again, then shame on them. That's about all we got for today, Louis, but if anybody wants to get in contact with you for your services, can you basically tell people about your services and your website and how they can get in touch with you?
Sure, Ryan. As we discussed earlier, people who follow real estate almost follow real estate in a vacuum. What smallgold.com does, SMAULGLD, is analyzes real estate with an economic backdrop. If you go to smallgold.com, you will see advice for realtors on how to do marketing, but you'll also see a heavy emphasis on analysis of the existing economic data and where we think the economy is going and what that would mean for the real estate market. So if you go to smallgold.com, SMAULGLD, it's SMAULGLD, smallgold.com, and go to the About section, you'll find all of my contact details.
Perfect. And guys, if you have any questions regarding anything that we covered today, if you're trying to buy a home and you're looking to, even if it's anywhere across the country and you'd like me to connect you with a real estate agent or a mortgage professional that I think would take care of you and address your individual needs, we'd be glad to do that. You can reach out to me via the website at realestate360live.com. That's realestate360live.com. On the right-hand side, there's an Ask the Question button where you can put in your question and contact information, and we'll get back to you. Outside that, guys, have a great week. Louis, thanks a lot, and we'll be talking to you soon.
Thanks, Ryan. Thanks, guys.